Massive institutional capital moves silently beneath the surface of the retail markets, leaving only sudden, massive footprints behind. We saw exactly this kind of footprint on May 24th, when a single, highly unusual block order hit the options tape for GE Aerospace. An institutional buyer stepped in, purchasing 272 contracts of the August 21st $300 call. They filled near the mid-price at $24.92, opening a brand new position. This single transaction carried $677,800 in premium. It represented 83% of the entire daily volume for that strike, instantly tripling the existing open interest. With a 0.56 delta, this buyer is paying for roughly $15,200 of directional exposure for every single dollar GE moves upward. That requires absolute conviction. The timeline reveals a paradox. The August 21st contract expires weeks after GE's Q2 earnings on July 16th and the Farnborough Airshow. A bar chart of open interest shows the market heavily clustered around the July 17th expiration. The August chain is a ghost town. The smart money deliberately paid top dollar for illiquid August contracts, specifically to step completely over the highly liquid July event. To understand why, we have to look at the flaw in how retail models price GE. A retail quantitative model will look at this institutional flow and fail to explain it, because those models are running off corrupted historical data. This composite chart shows a 20-year seasonality curve for GE stock, suggesting a reliable buy window from December to March. But that data is fatally flawed. It blends 20 years of conglomerate price action with barely 22 months of pure-play aerospace data. Following the spin-off in April 2024, the GE you trade today is strictly a manufacturer and servicer of commercial jet engines. Because of that singular focus, the market rewarded the stock with severe multiple expansion. GE now trades at a 35 to 40 times forward price-to-earnings ratio. Any valuation model or seasonality chart built when they traded at 15 times earnings is obsolete. Historical calendar months do not dictate edge anymore. For a pure-play aerospace stock trading at a 35 multiple, the only fundamental driver that matters is the strict sequencing of its catalyst events. If we want to reverse engineer the timeline logic of that $677,000 block trade, we have to transition away from seasonality and look at the math of the options chain. This data table shows the implied move term structure across the 3 immediate expirations. By checking the pricing of at-the-money straddles, we can see exactly how much volatility the market is pricing in over time. Both the July 17th and August 21st expirations contain the July 16th earnings print. By subtracting the July variance from the August variance, we isolate 35 days of pure, non-event trading time. The math reveals a base implied volatility of 37.4%. Subtracting that from the July term structure leaves an implied earnings day move of exactly plus or minus 6.0%. At first glance, a 6% implied move seems high compared to GE's historical earnings volatility rating, which sits at a very low 2.0. But that metric is completely broken. Over the last 2 quarters, GE's realized moves on earnings day were negative 7.4% and negative 9%. The options market is relying on stale, conglomerate-era volatility ratings. As a result, market makers consistently underprice the realized downside risk of the new aerospace entity.
Modern algorithmic sell-offs are purely mechanical processes, triggering violent, cascading price drops that completely ignore any underlying human sentiment. This chart plots 5 consecutive green EPS beats for GE post-spin. Yet beneath that baseline, 4 of the last 5 day 1 stock reactions were negative. The buy-side algorithms are punishing beats because of the multiple. At 35 times forward earnings, guiding for mid-teens commercial revenue reads as a fatal deceleration compared to the 20% plus growth they printed previously. This margin compression stems from an unfavorable mix shift on the factory floor. They're delivering more lower-margin initial engines and fewer high-margin aftermarket spare parts. We can prove the smart money sees this margin knife falling again by looking at the volatility skew. This volatility skew curve plots implied volatility against strike price. If we look at equidistant out-of-the-money options on the July chain, the $270 put trades at 42.1% IV, while the $330 call trades at only 38%. Traders are willing to pay a massive 4-point volatility premium strictly for downside protection. The pronounced put skew is the definitive signal. institutional capital is actively bracing for a third consecutive, structurally automated sell-off driven by margin mix. That alone explains the bearish earnings mechanics, but it leaves out the massive bullish catalyst trapped just 4 days later. The Farnborough Airshow opens on July 20th. It serves as the primary engine for multi-billion-dollar commercial leap order announcements. Historically, the volume of bookings announced at these biennial events generates the necessary momentum to re-rate aerospace multiples upward. This creates a severe timing trap. Q2 earnings drop on July 16th, placing a mechanical sell-off directly in the path of the July 20th airshow opening. If you buy the July 17th earnings expiration, a standard 7% drop on the print stops out the position and triggers a heavy IV crush before the airshow even begins. To capture the aerospace supercycle's upside, you must engineer a position wide enough to absorb an underpriced earnings crush without bleeding out your capital. This brings us back to the optimal retail expression of the institutional thesis, the August 21st 310/330 call spread. This P&L diagram maps the payoff for a bull call spread. The mechanics are simple. You buy the 310 call and sell the 330 call. This explicitly defines your risk and caps the premium bleed. Entering this spread requires a debit of $7.40, which floors your maximum loss at $740. In exchange, it targets a maximum profit capped at $1,260. This creates a highly favorable 1.70 to 1 risk-to-reward ratio, with a realistic break-even point sitting just 5.3% higher at $317.40. This structure resolves the paradox of the $677,000 block trade we saw on the tape. The institution chose August to secure a structural advantage. By holding the August position, the trade absorbs the mechanical July 16th margin drop, survives the subsequent IV crush, and secures 4 uninterrupted weeks of post-airshow drist to realize maximum profit on Farnborough leap orders. In a regime defined by contaminated backtests and automated sell-offs, structural edge belongs exclusively to those who map the catalyst sequence and strictly define their risk across the volatility surface.